Do you believe that purchasing a business in the stock market signals the end of the stock market? If this is the case, you are one of the least invested investors I have ever seen. Today, we'll talk about bonds, which are seen to be more valuable than stocks on the stock market. A bond is a pledge to lend money quickly and to receive interest. In other words, it is a certificate granted by the government, local governments, public institutions, financial institutions, and businesses to borrow huge sums of money required to carry out programs or projects all at once and use them over a long period of time. Bonds have a unit price, maturity date, and interest rate. Following issuance, interest is paid to the creditor, or the investor who purchased the bond, on a regular basis or at maturity. The principal is also refunded at maturity. Although the maturity date is predetermined, it can be sold to others before that date, making it distinct from other types of debt agreements. It is a method of investing that stands out for its stability, as bond investors are extremely likely to get the principal and interest as initially stipulated. It is mostly issued by institutions with high creditworthiness, such as financial institutions and government agencies, where payment of principal and interest is 100% guaranteed. Even if you invest in such a way that you do not retain it until maturity and sell it halfway to earn a profit, the risk of investment loss is extremely minimal because the market price does not change as much as stock prices. There will be those who are increasingly interested, and those who are not. Learn more about the economy, bond prices, and interest rates. The following is the process through which a growing economy rises interest rates. Bond issuance increases to circulate funds as demand for funds increases and the market becomes relatively short of funds. As a result, bond prices decline and interest rates rise. When the economy is doing well, spending rises, and the supply of money falls short of the market's demand for money. The federal government, public institutions, and corporations seeking financing will then intensify their bond issue activities. As a result, the bond market's supply of bonds grows. When the supply of bonds increases, so does demand, and the price of bonds declines. Bond issuers then raise the coupon rate in order to sell bonds. Interest rates will rise as a result of this. You should now understand how bonds rise and fall in value. So, when should you buy and when should you sell bonds? Bonds can be held to maturity and receive periodic interest payments, or they can be sold in the middle to realize capital gains. In the case of a discount bond, if the bond is held until maturity, you can select a bond with a high yield based on the difference between the par value and the issue price, as well as the interest rate based on the coupon rate. You can buy when the market is low and sell when the market is high if you wish to sell at a profit before maturity. Interest rates rise, bond prices fall, and bond sales result in a loss. Interest rates fall, bond prices rise, and bond sales profit. Bond prices will rise if market interest rates fall in the future, so now is the time to buy. You can gain a large return on your investment if you acquire a stock and then sell it when the market price has risen sufficiently, i.e. after interest rates have reduced sufficiently. In this situation, the lower interest rates fall, the higher bond prices climb. If market interest rates continue to fall for an extended period of time, bond prices will climb, allowing you to realize big capital gains by purchasing long maturity bonds. So, what exactly are bonds? Bonds are classified into three types based on who issues them: government bonds issued by the government or public institutions, financial bonds issued by financial institutions, and corporate bonds issued by ordinary corporations. Where can I buy bonds? Bonds, like stocks, are only traded in registered stocks that meet certain criteria. Trading conditions are fixed, and trading time is strictly limited. Stocks are mostly traded in the regular market, also known as the exchange-traded market, whereas bonds are mostly traded in the over-the-counter market, also known as financial institution windows. Large amounts are typically traded individually through a securities company's bonds department or between securities companies and institutional investors, which include securities companies and other financial companies or corporate corporations, and institutional investors. So, how is the bond market now? Let's take a step back from here. COVID occurred about a year ago, and the Fed continued to slash interest rates, and the actual interest rate reached negative. Furthermore, by expanding the money supply, it cut interest rates. Bond prices should rise because interest rates and bond prices are negatively connected in theory. However, because to a particular circumstance known as Corona, even bonds decreased in value because the market was deemed unstable. The issue occurs afterwards. Because the price did not rise when the opportunity to rise arose, the bond price will continue to fall as interest rates rise in the future. So, what should we concentrate on now? Are bond prices currently at an all-time low? Or will it continue to fall? Need to consider. According to my observations, the market has already reflected the liquidity recovery and the proposal to raise the maximum interest rate through the dot plot stated at the FOMC meeting. The current amount of interest rate hike is significant, and based on prior experience, it is unlikely that it will grow any higher. Furthermore, due to the inflationary crisis, now is not the time to offer liquidity. Furthermore, you should be aware that long-term interest rates are inherently higher than short-term rates. The current interest rate disparity, however, is reversed. For example, the difference between the interest on a 1-year bank deposit and the interest on a 10-year bank deposit. In which circumstances will you be more interested? It's usually the latter in my mind. Of course, this is due to the lengthy deposit time. However, the current position is that you get more money if you leave your money in a 1-year bank. This is completely incorrect, and the market recognizes it and tends to revert. Based on this, we may conclude that it is an excellent area to invest in long-term bonds. It is assumed that the period of growing interest rates has been reflected, and given the difference between long-term and short-term interest rates, it is a very favorable moment to buy long-term bonds. The advantage and downside of bonds is that liquidity is limited, but the TMF ETF with 3x leverage can help to overcome this. Our J&J stock storytelling explains why you should purchase bonds now to those of you who watched today. Will you simply observe? Or will you take part? Remember the investment principle stated in the last video, the market merely requires understanding. I'll be back with a better video next time.